When geopolitics escalate, why does oil start trading like a security asset, and how does that reprice currencies so fast?
Because markets price probabilities, not certainty. War risk is the expected cost of disruption, not the disruption itself. Oil is globally priced and instantly hedgeable, so the risk premium shows up in futures and options first. FX then moves as investors rebalance toward perceived safety and liquidity, and as countries' expected trade balances shift with energy prices.
What exactly makes up the Middle East risk premium in oil prices?
It's a bundle: higher probability of supply outages, wider shipping and insurance costs, and fear around choke points. Then you add the cushion, spare capacity and inventories, and how credible that cushion is. Finally, positioning matters. If traders are short, headlines force fast covering. Futures react to revised probabilities immediately, while physical barrels reroute more slowly.
How does an oil risk premium travel into rates and the dollar?
Higher oil raises near-term inflation prints and inflation expectations, which can push nominal yields up. If central banks lean hawkish, real yields can rise too, tightening financial conditions. In stress, investors often demand USD liquidity for funding, margin, and safe asset preference. So paradoxically, USD could strengthen while oil-driven energy costs weaken importers' trade balances.
Where do petro-currency dynamics actually matter for FX pricing?
They matter at the margin through settlement and recycling flows, who invoices energy in which currency, and where exporters park surpluses. If sanctions risk rises, some actors could prefer alternative settlement routes, shorten duration in reserves, or diversify away from certain assets. Those choices can nudge FX demand, even if the system remains dollar-centric overall.
How should investors think about CAD versus NOK exposure when oil moves?
Start with terms of trade, but add institutions. Norway has a large sovereign wealth framework that can smooth flows. Canada's oil impact is more tied to private investment, regional constraints, and broader North American cycles. Then compare central bank reaction functions and housing sensitivity. Finally, watch positioning and risk off. Correlations can break if global growth fear dominates.
Why treat gold as a political hedge here? And what's the actionable takeaway checklist?
Gold can hedge policy and sanctions tail risk because it's no one's liability and can reduce reliance on specific payment systems. The checklist: track 1. Risk premium inputs, choke points, spare capacity, inventories, positioning. 2. Petro-flow narratives, settlement shifts, reserve behavior, recycling. 3. FX sensitivities, CAD versus NOK policy and growth exposure. Then size hedges based on regime uncertainty, not headlines.